Well, it is 11:02. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and we welcome you to our webinar dealing with the Tax Cuts and Jobs Act of 2017. What does this mean for us? We're not going to cover all of the aspects of the Tax Cuts and Jobs Act of 2017 since we are not an accounting firm or a legal firm, but we are going to try to take a look at some of the possible major and minor effects in regards to our behaviors in regards to contributing, taking distributions from retirement plans, as well as other items that are included in the new tax law that just got recently passed in regards to its effects on our tax-favored plans, retirement plans, mainly our individual retirement accounts as well as some employer-sponsored plans such as your 401k plan, your SEP plans, and simple plans that we currently offer at the Entrust Group. Now, a quick disclaimer, Entrust, again, is not an accounting firm or a legal firm, so we do not offer investment advice or endorse any products, nor do we offer any legal advice or tax advice. All the information that we're providing is purely educational, just to give you a high-level overview of what those effects are of the new tax law in regards to the retirement plans that we currently hold or you're considering to establish. There are some opportunities and there are some changes in regards to our decision-making process. It is always advisable to include your tax or legal advisor in making those decisions. Along with the fact that we can't make, give any sort of advice or legal opinion, there are some pieces to this particular piece of legislation that still needs guidance from the Internal Revenue Service in regards to its total effect on how we're supposed to carry out some of the pieces of the new tax law. So just keep in mind some of the issues, although on the surface we may be looking at that, and interpreting it one way, the IRS could reserve the right to always issue more pronouncements or additional guidance in regards to its net effects on how we're supposed to use that for our tax returns and or its net effects on retirement plans. So there's more to come. This is just a high-level 10,000-foot dive in regards to specific topics and its effects on retirement plans. The main focus of this particular course, again, is not to focus on all the pieces in the Tax Cuts and Jobs Act of 2017, but we're mainly going to take a look at the effect of personal deductions, the changes in the marginal tax rates in regards to making IRA contributions. Big question a lot of people have during tax time is which one's better for me, a traditional or a Roth? And one of the things that they're taking a look at is, can I get a tax deduction? If I can't get a tax deduction, I might as well consider a Roth. There are some changes that we might need to know in order for us to determine which type of IRA we would want. As well as with the changes, there are lowered rates for certain individuals that might want to consider what we call a conversion. Conversion is not a spiritual experience, but it could be. A conversion is basically converting your assets that have never been taxed before to an account that hopefully will never be taxed ever again. And what I mean by that is from a traditional to a Roth, or from a 401k plan to a Roth. There are also opportunities for employers to make retirement plan contributions given the fact that there are some big breaks for businesses. And if you have a break for a business and not having to pay as much tax, it means that there's tremendous opportunities for employers to contribute to retirement plans. We'll also take a look at the repeal of recharacterizations of conversions. Mainly conversions. Recharacterizations is not completely repealed, but the main repeal that we see in the legislation is the repeal of recharacterizing a conversion. That could pose to be a huge strategy loss for certain individuals that may convert from their traditional to a Roth, but decide to undo it later on in the year. We'll take a look at some of those examples as well. We'll also take a look at the penalty exemption for medical expenses. There's currently from an IRA perspective, taking distributions from an IRA to pay towards medical expenses that are deductible on an individual's tax return if they itemize, there's a slight change to that. It doesn't affect a whole lot of Americans, but for the ones who are affected, that's significant for them. We'll also try to take a look at change in the 529 plan, as well as miscellaneous changes to other types of retirement plans that we currently do not service at the interest group, but it's good to know what those changes are, just in case that particular change affects you. And then we'll open up the phone lines for a question and answer session. Now, keep in mind, there are several hundred people that are attending this particular course. We may not be able to get to all of your questions, but number one, this course or this webinar is recorded. And number two, send us your questions, and let's see if we can answer those questions for you. Or if not, we always reserve the right to send you to your tax or legal advisor for a specific determination in regards to your own specific information. Now, a little bit about the Entrust Group. The Entrust Group is a self-directed retirement plans administrator. In other words, we're a record keeper. We do not offer investments, but we offer a platform that allows for you, the investor, to choose the type of investment that you'd like to place under your tax-deferred account. In other words, your retirement account. Again, we don't offer any investments. We are a leader in the industry. We've been around for over 35 years and process over 12 to 16,000 transactions on a daily basis for multiple clients. And one of the features that delineates us from the rest is the fact that we do provide some education, high-level education, enough information, hopefully, to allow for you, the listener, to make an informed decision. We administer over $3.2 billion of investor assets, which is quite a bit of assets in the alternative investment space. In other words, the types of assets that we record keep are your standard assets that, not standard, but typically your assets that a lot of other financial institutions won't hold under a retirement plan, although they're allowed. We have a knowledgeable staff. We do own a school that prepares individuals for what we call the CISB Designation through the American Banking Association, through the Institute of Certified Bankers. It's called a Certified IRA Services Professional designation. Our courses are used sometimes by individual practitioners and professionals for continuing education for their actual designation. We provide these courses either national or local, nationally through webinars like this, or locally through presentations by some of our qualified staff, as well as we have a school that we are going to be holding in Chicago, Illinois this year around October, called the IRA Academy, which is a preparatory course, again, for the CISB designation. I'm kind of going really fast on this because I know that a lot of you are attending this course not to know about us, but to know more about the legislation. Here we go. Let's dive into the information. One of the biggest changes in the tax law is for personal income tax purposes. In other words, the reduction of taxation for an individual. But before we dive into that, there are typically three different adjustments to what somebody makes in a particular year before the taxation is determined for an individual. In other words, it doesn't matter. Let's say you make this much, and it doesn't matter how much that is. That's personal to you. Uncle Sam says, if you make a certain dollar figure, I won't tax you in that much. I will allow for you to adjust it three times. And the factors that reduce whatever you make to determine taxation is, number one, is the result on that is what we call the adjusted gross income. The typical reductions to an individual's income on line 7 of the IRS 1040 includes 401k deferrals as an example, cafeteria contributions. If you participate in an employer's, let's say, health insurance program, that will reduce your income. Section 125, flex plans. HSA contributions on Part 2 of the IRS Form 1040. For self-employed individuals, and we're going to try to focus on that a little bit today. For self-employed individuals, sole proprietors, individuals who receive partnership income that has self-employment income in that, the contributions to an employer-sponsored plan, such as your SEP, your SEMPL, your 401k plan, those are all deductible on Part 2 of your individual IRS Form 1040. Those are just examples of some of the deductions or the adjustments to an individual's income for the first step. When I say the three adjustments, this is typically how we do it. As a matter of fact, it's tax time. We're talking about 2017. There are some dramatic changes, or I would say not so dramatic, but there's some changes to how we figure that out starting 2018. But for adjusting an individual's income for the year, that's the first factor. The other factor that reduces an individual's income before taxation is determined is the greater of the standard deduction or itemized deduction. In other words, another way of looking at that is Uncle Sam will either give you a dollar figure, depending upon how you file your tax return, whether it be your single filer, a married couple filing a joint tax return, or head of household filer. Uncle Sam will give you a number to further reduce your income. Or if you have enough expenses that you can actually list, or in other words, itemize, of course it doesn't take a rocket scientist to figure out to choose the larger one of the two. Once you choose the larger one of the two, you further reduce your income for the year before taxation is determined. Last but not least, personal exemptions is the final one that reduces an individual's income or a married couple filing a joint tax returns income. You take a look at your personal exemptions, how many dependents you have in your household. Whatever that number is, you multiply that by a number. In 2017, it's 4,050. Depending upon how large your household is, so let's say you have a ton of kids, no television, well, guess what? That 4,050 is multiplied by the number of exemptions. This is typically how we calculate that. Now, depending upon your income, of course, that personal exemption gets phased out. In other words, you can't use it if you make too much money. But typically, this is how a typical American goes through and figuring out what amount that they have that's taxable. Whatever's left over after the three adjustment is not taxed at the same rate. They're taxed at different rates. Now, maybe I'm going too elementary for some, but for some, this is the first time you've seen this. So I want to go through this first to make sure that as we go through the different changes, you can identify which portion of the three adjustments have been affected by the new tax law change. Again, if for 2018, which is the effective date of the Tax Cuts and Jobs Act of 2017, these three particular adjustments are affected. First, starting off with the adjusted gross income. Now, let's take a look at the adjusted gross income. What effects are there in the adjusted gross income? Well, one of the biggest effects is for entrepreneurs. For entrepreneurs that are non-C Corps, in other words, if you're a sole proprietor, your partnership, which, by the way, LLCs could either be a sole proprietor if there's only one of you. It's called a disregarded entity by the IRS. Or if there's more than one of you in an LLC, you're considered a partnership. If it's an S Corp, those are the individuals also receive pass-through income. And if they work for the actual S Corp, they also receive a W-2 wage. Well, under the Tax Cuts and Jobs Act of 2017, given the fact that corporations are given a big tax break, in other words, the amount of tax that they would have to pay is hopefully going to be it will be a lot smaller in 2018, given the fact that the rate has been reduced from 35% to 21%. These are for corporations. So Congress also wanted to give a break for those individuals that receive what we call pass-through income. As many of you know, for example, partnerships, the income is actually not paid by the partnership. It is passed on to the partners of the partnership, or if it's an LLC, the members receive the actual income of the LLC. In other words, that income is not taxed at corporate rates, but it is taxed at the individual rates. And for many of you who don't know this, but corporate rates are typically a lot larger than individual rates. Well, what about those individuals that receive that pass-through income? Uncle Sam also wanted to give them a break, and this is where this 20% tax deduction comes into play. There are certain limitations on how much can be deducted, which is the greater of 50% of all the W-2 wages that is paid by the pass-through entity, or 25% of the individual's W-2, because that 20% deduction is for the individual. Certain types of individuals are typically excluded from this 20% in the fields of health, law, engineering, architecture, accounting, financial services, brokerage services, or consulting. However, if the income of the individual, it falls below a certain dollar figure, well, then all these limitations do not apply. And that limitation or that limit is $157,500 for a single filer and $315,000 for a married couple filing a joint tax return. Now, keep in mind, again, we're not going into too much detail on the changes, but I just wanted to let you know that if you are a sole proprietor or partnership, and depending upon your income, you may be eligible for this pass-through income tax deduction. I want to check with your tax consultant. Now, what if the income falls above that? Well, then the deduction starts to get decreased and phased out up to $100,000 above those particular thresholds that I talked about. So in other words, the more income you make, the less of the 20% deduction you get if that entity is eligible for it. Now, keep in mind, the income that is used is what we call a qualified business income. In other words, from whatever the entity receives and after expenses, that's what we call the qualified business income. Now, keep in mind, if an entity has employees, retirement plan contributions are deducted to determine or put in consideration in coming up with a qualified business income. Given the fact that, if the income is below a certain threshold, some of these exemptions, do not apply. Well, it might be advantageous to run the numbers. If making a retirement plan contribution on behalf of your employees may put you below that threshold, it may be something to consider. From a strategy purposes, it may be something that you might want to take a look at with your tax advisor. Whereas some organizations before never even thought about making retirement plan contributions on behalf of their employees because they already had a high rate of taxes, as well as the income that they're receiving is not enough to share any sort of profit. You might be able to have an opportunity for the coming year to do that, depending upon how your business does, as well as whether or not you can actually afford to make that contribution. But keep in mind, retirement plan contributions may reduce that QBI. That would allow for the individual to take that 20% deduction. Now, where do we get QBI? The QBI determination is typically the Schedule C for a sole proprietor. For a partnership, it's a Form 1065, and for an S corp, it's the IRS Form 1120. As you can see, I cut and paste a certain portion of the form that shows pensions and profit sharing plan contributions. That includes your SEPs and SIMPLs as well. Those contributions are used to reduce contributions to employees are used to reduce the QBI for the individual. So therefore, if the QBI is reduced, that might allow for the individual to actually avail of the 20% deduction. Anyway, again, if you have any more questions, check with your tax advisor. Now, for retirement plan contributions for the actual sole proprietor themselves, as an example, that is not deducted on the Schedule C. That is deducted on the individual's income tax return. If it's used as a deduction on the individual's income tax return, that will further adjust the individual's taxable income. Again, if a sole proprietor has not made retirement plan contributions, this may be a good opportunity to further adjust your own personal income if you make a retirement plan contribution to, for example, again, a SEP, a SIMPL, an individual 401k plan. If you want to find out more about these types of plans, there is a publication 560. Again, publication 560 is a publication that the IRS has provided for many, many years that speaks on the different types of retirement plans small businesses can establish. The benefit of that is by contributing to a small business plan, that amount is used as a tax deduction. And for self-employed individuals, it is actually a tax deduction for their contribution for themselves on their own IRS 1040. On the previous slide, if you have employees and you make contributions to your employees, those are used as a tax deduction on the specific forms. Schedule C for sole proprietors, 1065 for a partnership, and last but not least, 1120 S for S corps. So In other words, those are actually used as a tax deduction. Let me give you an example. The maximum contribution for sole proprietor, as an example, is the lesser of 25% of income, or $54,000 for 2017. That's a lot of money. So if you want to shelter, if you did very, very well and you wanted to shelter a certain level of income that you've made that otherwise would be taxable, but instead you can put that in a retirement plan and use it as a tax deduction on your tax return, it may be worth to consider contributing to an employer-sponsored plan to further reduce your taxable income. Now, adjusted gross income, because of the fact that there may be increased profits. If your level of income stays the same, and then but you have to pay less taxes, of course your profits are going to increase. Yeah, you have an opportunity to be able to infuse capital to grow your business if that's what you'd like to do, and of course, meaning growth in business, infusing capital in your business means potentially more profits, being able to take on more jobs without having to borrow money. But it also allows for an investor to be, or an entrepreneur, to make retirement plan contributions on behalf of employees, not only to retain employees, but also to bank away for your own personal retirement because you are an employee as well. Small businesses historically prioritize taxes versus making retirement plan contributions because instead of having to, if you have to pay taxes, well, how can you make a retirement plan contribution? Although a retirement plan contribution reduces the amount of tax you'll have to pay, there's a conversation that has to take place on which route an individual wants to take. And that's the good conversation to have with your tax or legal advisor. Again, last but not least, self-employed individuals' contributions for employer-sponsored plans are deducted in their own personal IRS Form 1040, which again should reduce their adjusted gross income, which out of the three different reductions to an individual's income before taxation, that's one of them. Enough said. Let's take a look at the second tier of adjustments to an individual's income before taxation, and that is standard deduction versus itemized deduction. In other words, would you take what Uncle Sam provided to you as a number, or would you take or list the types of expenses that you have that are deductible? Let me give you some of those expenses that are deductible for 2017. State and local income taxes, property taxes, charitable contributions, medical expenses that exceed a certain threshold of your adjusted gross income, mortgage interest, which is another big one. Those are types of expenses that can actually be listed and itemized. And of course, again, it doesn't take a rocket scientist to determine which one of those numbers you will choose. Will you choose what Uncle Sam gave you, or would you choose the listed expenses that you have? Well, there are changes to the itemized deduction as well as the standard deduction that you might want to take a look at to determine which one of those you will choose. Now, why are we talking about this? Because this will affect your decision-making process of whether or not you would like to, contribute more, contribute to a traditional or a Roth IRA. Because in a traditional IRA, you can potentially use that contribution as a deduction, whereas in a Roth IRA, you cannot. Your income may be higher in some cases, or it may be lower, depending upon what you can and cannot deduct. Another thing that individuals need to take a look at is the fact that distributions from IRAs are includable as taxable income. Distributions from IRAs may be taxed less for some people next year. What I mean by next year is 2018 opposed to 2017 because of these changes. And let's go over it, and I think you'll know what I'm talking about. For a single filer, the standard deduction, let's take a look first at the standard deduction, and we'll take a look at itemized deductions and the changes of that. Keep in mind again, it's standard deduction versus itemized deductions. The standard deductions is doubled for 2018. For single filers, typically what you can reduce your income with is $6,350 as a flat amount if you decide not to itemize. For 2018, it's $12,000. It's doubled already, or somewhat doubled, not quite fully doubled. Do the math. Right. A head of household filer, it's $19,350, but for 2018, It's $18,000. It's almost doubled for 2018. And for joint filers, it's $12,700. Where did I get the 19? $12,700, and then $24,000 for 2018. Now, keep in mind, by raising the standard deduction, obviously you might be thinking, well, they must have affected the itemized deduction. Well, they did. Keep in mind, again, the standard deduction is doubled in 2018. Therefore, there might be some changes to the itemized deductions. Therefore, typically, state and local income taxes didn't have a cap to it, or didn't have an amount or cap to that amount. Now, state and local taxes, especially for individuals that live in states that have state tax. I used to live in a state in Minnesota that had state tax. We had to support two things, winter and road construction. So our state tax was high. So for people in Minnesota, you could actually use that as a deduction. That has now been capped. So when you see in the news SALT, in other words, it means state and local taxes, those are capped. State and local taxes, which includes property taxes, are capped at $10,000. If you historically been able to use that amount as a deduction, now you're going to be capped at 10. That might be worth looking at to determine where else can I get, what else can I participate in other words, contribute to, that hopefully will adjust my income. In other words, reduce my income further so that the amount of taxable income that I have will be a lot smaller. Well, retirement plan contribution is one of those strategies that an individual may want to consider contributing to, since they can no longer sometimes, in some cases, depending upon your number, deduct what you historically could deduct. HELOC, or home equity line of credit interest, can no longer be used as a tax deduction. Certain individuals before, instead of getting a loan to buy this to do home improvements in their house, as an example, may want to get a home equity line of credit, and one of the incentives is that the interest in that home equity line of credit, not your first mortgage, but a home equity line of credit, may be used as a tax deduction on their tax return. Well, that's a thing of the past for this particular piece of legislation. Now, keep in mind, this piece of legislation is set to expire in 2025, which means we go back to the old rules after 2025. So although I say it's a thing of the past, it may resurrect itself again. Here's another change. Amount paid toward medical expenses, that's above 7.5% of the adjusted gross income. For some people who have a lot of medical expenses, based on their adjusted gross income, you multiply that by 7.5%. Only the amounts that are above 7.5% of the adjusted gross income. In other words, you have a lot of medical expenses. If your medical expenses exceed 7.5% of your adjusted gross income, the amount that's above 7.5% may be used as a tax deduction in your tax return in 2018. Now, keep in mind, in 2017, that was 10%. Because of the Health Act that was passed in previous years, that 7.5% was increased to 10%. In other words, only medical expenses that exceed 10% were used as a tax deduction. We're back down to 7.5%. Now, we're going to pull this 7.5% back into play when it comes to IRA distributions. If individuals took a distribution from their IRA to pay towards medical expenses that are above the 7.5%, the distribution from an IRA is exempt from the 10% early distribution penalty. But for all intents and purposes, let's focus on itemized deductions. Only medical expenses that exceed 7.5% of the adjusted gross income of the individual may be used as a tax deduction. Again, if you have further questions on this, either email us, and if we can't answer it directly for you because it's a tax question, you might have to refer you to your tax or legal advisor. Charitable contributions have also been changed. In other words, the amount that you can typically deduct based out of your income has been increased. A lot of people don't donate more than a certain dollar figure because if they can't use it as a tax deduction, why contribute, right? Well, charitable contributions that are within 50% of the individual's income may be used as a tax deduction. That 50% has been increased to 60%. Hopefully that will increase the amount of people contributing to charity. Given the fact that you can no longer deduct certain items, this may be a way for you to deduct more to reduce the amount of income that's going to get taxed. There are others that are also changed. Unreimbursed employee expenses and other miscellaneous deductions, theft and personal casualty losses. Certain casualty losses in federally declared disaster areas may still be claimed. There's a little variation to that. So check with your tax advisor when you're dealing with your typical deductions, because those may have been affected, that you might want to strategize before the end of the year on what you're going to focus on to hopefully maintain the level or amount of deductions you're going to get for 2018, because there have been some changes to that. Again, we talked about deductions. Do you want to take the standard deduction or you want to take itemized deduction? There's some conversations, brave conversations have to occur between you and your tax advisor to determine, what you historically could deduct before. You may not be able to deduct again moving forward. You might want to consider other types of contributions to maintain that level of deduction, so so that you can reduce that same amount for 2018. Now, what does that mean for individuals? You might want to consider making retirement plan contributions, or you also might want to increase, if you don't already have maximized, HSA contributions as an example, because HSA contributions, if you're eligible for it, if you are participating in a qualified high deductible health plan, the HSA contributions are a straight line deduction on an individual's tax return on Part 2 of the IRS Form 1040. If you're looking for deductions, this may be something that you might want to consider, or increase your 401k contributions. Why increase your 401k contributions? Because that 401k contributions adjust your income, adjust your line 7 of your IRS Form 1040. Again, making these contributions are a way to offset the amount that you typically could deduct but may no longer be able to deduct moving forward. Now, last but not least, what adjusts an individual's income, and that's personal exemptions. Depending upon how many dependents you have in your household for 2017, you multiply that by a number. It's for around 4,050. For a family of 4, in my example, it would be 16,200. That further reduces an individual's income. Now, that has been reduced to 0. In other words, it's not available from 2018 to 2025. Personal exemptions are no longer available starting 2018. So if you're counting on that personal exemption based on the number of dependents that you have in your household, not around for 2018. Now, after those 3 reductions occur, then the individual gets taxed at different rates. The marginal tax rates, or the tiered rates that we typically look at, have changed. Here's a comparison. Compared to 2017 and 2018, there is no change to the 10% brackets. In other words, for the first level of income, as an example, for a married couple filing a joint tax return in 2018, as an example for the 10% tax bracket, between 0 and 19,050 gets taxed at 10%. That remains the same. But starting in 2000, but starting for the income above that, if you still have left over that's above 19,051 up to 77,400, in 2018 that's only going to get taxed at 12% instead of 15%. So in other words, the taxation of an individual's income is going to be lowered in 2018 for the lowest level of tiers. In other words, it's going to affect a lot of Americans. For the people in the 25% tax bracket, you're going to pay 22% instead of 25% in 2018. For people who are in the 28% tax bracket, in other words, you made a substantial amount of cash. Because I don't know if you know this, but the more income that you have left over, the more taxes you pay on what's left over based on the level of your income that falls within that tier. I don't have those numbers in front of you, but those are conversations that you might want to have with your tax advisor, especially if you're going to take a distribution from a retirement plan. Why is that? Because that's includable in your taxable income for the year. As you can see, the higher levels of incomes have been reduced. If you're in the 33%, that's going to get taxed at 32%. Between 33 and 35, that still remains at 35%. But If you're in a 39.6% tax bracket, that's going to be taxed at 37%. In other words, whatever those adjustments are that have been modified in 2018, whatever's left over typically going to get taxed less for majority of Americans. All right. Here are some examples of the effects of the new tax law. Let's take a look at an example. A single filer has a gross income of $60,000. In other words, that person makes $60,000 for the year. The employee participates in an employer's health plan and contributes to an HSA as well as a 401k plan. In other words, deferred taxation on their paycheck. Has an AGI of $52,000. In other words, after those deductions, whatever was left over in the first tier is $52,000. How is that going to be taxed in 2018? Let's do a comparison. If this person was going to, if we're going to determine taxation in 2017, $52,000 minus, let's say, the standard deduction, $6,350 minus the personal exemption if they're a single filer. Well, their taxable income is $41,600. However, in 2018, if we take a look at the same individual applying the new tax law, well, the standard deduction for an individual in 2018 is $12,000, dramatically increased. $52,000 will be decreased by $12,000. Now, the personal exemption, however, is eliminated, so therefore that $4,050 is not going to affect that taxable income. So as you can see, the taxable income is already a little bit less in 2018 in comparison to 2017. What does that mean? There's less income that's going to get taxed. Now, based on that, based on the rates, keep in mind again, as I mentioned, $9,520.50 is taxed at 10%, $952, and then at 15%, it's $4,811.25, with a total of $5,763. If this was 2018, the $952.50 remains the same, no change in 10%, but the 15% bracket will be taxed at 12%. In other words, a reduction in the amount of tax that they'll have to pay. So in this case, the amount of tax that the individual will only have to pay is $4,609.50. Now, this is a pretty easy example. Then at least hopefully you'll get all those different adjustments, so on and so forth that we talked about. And this is the net effect of the tax law change for an individual's tax return. In this case, the person will save around $1,154.25. Now let's take a look at another example. Single filer has a gross income of $60,000. In this case, let's change the scenario. This person has one child. The child tax credit, by the way, has been increased from $1,000 to $2,000. So my numbers may not be exactly the same, but it's all purely from a concept perspective. The employee participates in an employer's health plan as well as contributes to an HSA, all right? Has an AGI of $52,000, similar, but in this case now they have a child. Let's run through the calculations again. 2017, 52 minus the standard deduction, minus the personal exemption. In this case, it's two people, 8,100, 4,050 times 2, and then the taxable income is $3,750. Now, if this was 2018, the standard deduction is $12,000. 52,000 minus 12, no personal exemption, taxable income is $40,000. Now, keep in mind, the child tax credit again has been increased from $1,000 to $2,000. One of the things that stopped, was postponing the bill from being signed was there are two senators that say you need to increase that child tax credit, and this is why, right? Keep in mind, for 2018, even though the standard deduction was doubled, the personal exemption was eliminated, there is a deficit. The taxable income of the individual for 2018 is a lot larger than 2017. So, does that mean the person does not avail of the tax benefits of the tax cuts for 2018? Well, this is where it comes into play. For a child, it's no longer $1,000, it's $2,000. So if the individual owes $4,609 after the reduced rates, of course, in 2018, well, that $4,609 is going to be reduced by the $2,000 child tax credit, so therefore the individual would only owe $2,609.50. In other words, instead of just reducing it by $1,000, it's going to be a $2,000 reduction. So if you take a look at the numbers, even though there are certain things that are eliminated, they're hoping that it's compensated by, number one, the reduced rates, as well as increase in other credits that they may be able to avail of. One of the things I didn't put in consideration in here is what we call the retirement savers credit. For some of you, you may not be familiar with this. Based on your adjusted gross income, in other words, the individual's adjusted income already, if it falls below certain thresholds, you can multiply a percentage up to $2,000 of retirement plan contributions to determine an additional credit to your tax return. In other words, an amount that you wouldn't have to pay Uncle Sam. That has not been touched. So by making contributions to a retirement plan out of pocket, those contributions to a 401k plan, a simple plan, an IRA, a Roth IRA, if an individual falls within certain income levels, a certain percentage of the contribution may be used in the formula to determine a tax credit on an individual's tax return. That is still around. A recap, most people will hopefully be paying less tax, majority of the 300 million people in the United States at least. More individuals may consider contributing to their retirement plans, given the fact that they can no longer use certain elements in their tax deduction, such as state and local income taxes, as one of the big examples for those people who live in states that have state income tax. Reduce eliminated tax liability, potential contribution to a Roth instead of a traditional IRA. If an individual is not going to have to pay taxes because they don't owe anything, as an example, after they run their tax return or run the numbers in their tax return, what's a tax deduction going to do for you? If you contribute, since you're not paying taxes anyway, some people may want to consider a Roth contribution instead. Feasibility of converting traditional IRAs to or a distributable Roth 401k plans. In other words, your ex-employer's 401k plan that you used to participate in. A lot of people are retiring. 403Bs, governmental 457B plans. I want to, if you historically did not consider converting, in other words, taking a distribution, paying the tax on that to put that into a Roth, it may be something to discuss with your tax advisor to determine whether or not that's now feasible for you, given the reduced tax rates and tax savings on the new marginal rates for 2018. Again, last but not least, the tax savers credit is not eliminated. By contributing to a retirement plan, if an individual falls within certain adjusted gross income levels, whether it be a single filer, a head of household filer, or a married couple filing a joint tax return, a certain percentage appropriated to each one of those types of categories by making a retirement plan contribution can be used as a tax reduction, not a tax deduction, but a tax reduction. It will reduce the amount of taxes you'll have to pay by contributing to a retirement plan, if you contribute to a retirement plan. All right, enough said with the marginal tax rates. Let's move on to recharacterizations. What is a recharacterization? For some, you've never heard of this before. Given the fact that an individual can contribute to both a traditional IRA and or a Roth IRA, what if an individual changes their mind in making one contribution opposed to the other? In other words, given the fact that an individual has up until their tax return due date to make a contribution, what if you ahead of time make a contribution to a traditional and later on decide that, you know what, you'd be better off with a Roth? Uncle Sam said as long as you haven't filed your tax return, just move it. No taxation involved. In other words, it undoes what you originally did. A recharacterization allows an individual to switch from one type of IRA to another type of IRA by moving the contribution from the one type of IRA, whether it be all of it or only a portion of it, as long as the earnings go along with it, as if you made the contribution to another type of IRA. So you can go from a traditional to a Roth back to a traditional. And you can actually do that up until your tax return due date plus extensions. That term for that transaction is what we call a recharacterization. Recharacterizations are also used by savvy investors to undo what we call a conversion. I mentioned it earlier. If you've made contributions to your traditional IRAs or 401k plans in the past, and you have quit, as an example, and, hey, you say, I want to move that money into a Roth. Uncle Sam says you can do so, but you're going to have to pay taxes on it. Tax on what? If it's property, the value of the property you're converting. In other words, you don't have to sell the property. You can move it from a 401k plan to an IRA with mutual funds, stocks. You can move that same property into the Roth IRA and pay the fair market value. If it's an IRA, let's say if it's a house worth $100,000, you wanted to convert that to a Roth. Well, the $100,000 will be distributed, and then that property will be placed into your Roth. Now, the $100,000 is includable in taxable income. Now, some people say, you know what, $100,000, well, maybe in the beginning of the year you can afford to pay the tax on it, but later on in the year you change your mind. Savvy investors may choose to change their mind and want to unwind or undo that conversion that they did. In other words, taking it back out from a Roth, putting it back in a traditional. That transaction is also called a recharacterization. Now, why are we talking about a recharacterization? Because moving forward, under the Tax Cuts and Jobs Act, for conversions that occur in 2018, which, by the way, the year that the distribution takes place will determine the year of the conversion. So if they take a distribution in 2018, that's their year of conversion. If an individual took a distribution in 2017, that's a 2017 conversion. Conversions that occur in 2018 may no longer be recharacterized. We are still looking for additional guidance from the IRS on whether or not this rule applies to 2017 conversions. I hope not. I hope that they don't go retroactive back to individuals who did conversions prior to this law being passed. But I doubt if they apply to that. But the way we read the law right now, it only applies to conversions that occur in 2018. But more to come. Just confirmation from the IRS is what we're looking for. But 2018 conversions, those can no longer be undone. In other words, if you're going to convert, you need to make sure you wanted to convert at that point. Now, here are some examples of when a recharacterization can take place. Now, there's a lot of words here, but we'll show it to you in pictures as well. Let's say an individual has a traditional IRA that has a house in it worth $250,000. The individual decides to convert that house into a Roth IRA. The distribution will be taxed at the fair market value of that piece of property. The taxpayer will receive an IRS Form 1099-R for $250,000. That $250,000 will be includable in taxable income. As you've seen in the previous slides in how we get taxed, well, that $250,000 is going to show up at a higher tax bracket. Now, there are turn of events in investments such as homes. What if the house fluctuates in value after the conversion takes place? Now, is now only worth $150,000. Well, Uncle Sam says, as long as it's before your tax return due date plus extensions, you can unwind that conversion and put it back from the Roth back to the traditional. That transaction is what we call a recharacterization. So therefore, if it's recharacterized, then the individual won't get taxed on the $250,000. That recharacterization has been a strategy or a way out for individuals that are saying, you know what, I don't want to get taxed on this transaction that I did. Uncle Sam says as long as you haven't filed your taxes and plus extensions, or if you file your taxes timely, you have an automatic 6 months extension, just unwind it, undo it via recharacterization. Starting 2018, if somebody did a conversion, that can no longer be unwound. In other words, recharacterizations don't apply to conversions that occur in 2018. Contributions can still be recharacterized because there's no taxation involved in that. But recharacterizations, they're trying to focus mainly on recharacterizations. That recharacterizations, again, that occur in 2018 may no longer be recharacterized. Let's take a look at that example. An individual has a traditional IRA with a house in it, decides to convert it to a Roth. Now the Roth IRA has a $250,000 house. The house fluctuates in value. The individual will still have to pay taxes on the $250,000 even though it fluctuates in value because the fair market value at the day of conversion is what's going to be taxable. The individual could say, I don't want to pay taxes on $250,000. They can unwind it or undo it by recharacterizing it from the Roth back to a traditional. Thus, therefore, nullifies the taxation in the $250,000. Starting 2018, you can't do that anymore. Let's take a look at an example of a recharacterization. An IRA holder converts his traditional IRA worth $50,000 to a Roth IRA. Later on, the IRA holder figures out he cannot afford to pay the taxes on the conversion. One way to undo that again is by recharacterizing it. Moving forward, you can't change your mind any longer since recharacterizations are no longer going to be allowed. All right, so hang in there. We're almost done with the presentation, and we're going to open up the phone lines for any questions you may have in regards to the materials presented. One of the things that the Tax Cuts and Jobs Act affected are also other types of plans that are used for savings but are not retirement plans, one of which is what we call a 529 plan. Historically, 529 plans are basically a savings for an individual's, for example, a minor's education. And 529 plans are administered at a state level. Each state has their own maximum contribution amount because the cost of education in each state is different. Midwest, it's different than the East Coast. East Coast have a lot higher contribution rates in their 529 plans. Historically, 529 plans have only been used for higher level education, such as, college, university, vo-tech school that's eligible to receive federal aid. Moving forward, you can use 529 plans for additional purposes. You can take a distribution up to $10,000 for elementary and secondary schools. Now, that's a dramatic change. Why is that? Because historically, individuals can, if they wanted to contribute on behalf of a minor's education for elementary and, for example, high school, to be used for private schools as an example, would contribute to an education savings account, because education savings accounts were able to be used for elementary and secondary schools. Now, 529 plans may be used for elementary and secondary schools. Up to $10,000 may be distributed for such a reason, which may, tell me that Coverdell Education Savings Account may not be the best place to put contributions any longer. Now, if you have made contributions to our Coverdell Education Savings Account for that reason, well, it's not the end of the world. Taking a distribution from a Coverdell Education Savings Account and contributing that to a 529 plan is a non-taxable event, given the fact that contributions to 529 plans may be what we call a qualified eligible educational expense. Therefore, the distribution from the Coverdell is non-taxable. But just know that moving forward, 529 plans may be used for elementary and secondary schools. Up to $10,000 per year may be distributed from 529 plans. Now, here are some other miscellaneous changes. Louisiana victims of the storms, in other words, the 2016 federally declared disaster areas, they get relief. They can take distributions from qualified retirement plans, 403B plans, governmental 457B plans, as well as IRAs, and receive relief. What's the relief? The amount will not be subject to the 10% penalty. The maximum that qualifies is $100,000. It only applies to distributions between January 1st of 2016 and before January 1st of 2018. So in other words, those distributions that they took in that particular time frame will not be subject to the 10% penalty. They may also spread the taxation for a period of 3 years. This doesn't affect a lot of Americans, but it's good to know. They can also spread out the taxation into a 3-year time frame. They can also put the money back via what we call a rollover within that 3-year period. So in other words, if they needed some money to fix their house or whatever for the emergency because of the disaster, they will be taxed on it, but they will be exempt from a 10% penalty. Now, they can put it back, but when they're putting it back, they pay taxes on it. So therefore, there may be some tracking that the individual would have to do, typically what we call an IRS Form 8606, which tracks contributions that have been taxed already in a retirement plan. So there may be some conversations that need to occur between the taxpayer and the tax advisors in regards to this. All right. Additional items that are included in the Tax Cuts and Jobs Act. Extended rollover periods for loan offset amounts. What does that mean? Let's say you're in a 401k plan. You take a loan out of your 401k plan. You're making payments on that for a period of 5 years. Second year, you quit. Well, if you quit, sometimes those assets may be distributed, whether it be forcibly by your employer or you take a distribution yourself. Well, what do you do about the loan? The loan is typically taxable. However, the employer could basically distribute that amount as if it was taxable to you, but the individual could make that loan up by paying it back out of pocket and roll it over to another tax-deferred account. They typically have 60 days to do that. However, Congress extends that period to the time, an extended period of time. Uncle Sam says instead of having 60 days, the individual could actually have until their tax return due date plus extensions to repay that money back. In other words, an extended period of time to come up with the money so that they don't get taxed on that loan that otherwise would have been taxed if they did not make it up or pay it back. As mentioned earlier as well, the 10% penalty exemption for medical expenses now applies to any distributions from IRAs that are paid towards the expenses that are above 7.5% of the adjusted gross income of the individual. Prior to 2018, for a few years, we were at 10%. Starting in 2018, more of those distributions will be exempt from a 10% penalty if the distribution taken from an IRA is paid towards those medical expenses. I know you folks have a lot of questions. If you'd like to open up an account at the Interest Group, it's as easy as opening up an account, funding your account by a transfer or rollover, and last but not least, instruct us on what type of asset you want to purchase. If you wanted to transfer or set up an account right now, there's a $50 promo to waive the fees for setting up an account. We thank you for attending this webinar and hope to have you again in another Interest Group webinar in the future. Have a great day.